For decades, owning a house in United States was considered the ultimate sign of success. Stable life, safe future, financial security. Parents told their kids to buy a home as early as possible. Movies showed beautiful suburban houses as the symbol of happiness. Banks made mortgages sound like the smartest financial decision ever created. But today, that same dream is quietly turning into a long-term financial burden for millions of Americans. And the biggest reason is something most people ignore until it's too late: mortgage rates. Every time mortgage rates rise, the cost of owning a house explodes. Not just slightly. Sometimes by hundreds or even thousands of dollars every single month. And right now, mortgage rates in America are bouncing back again. People searching terms like mortgage rates today, current mortgage rates, mortgage refinance rates, mortgage interest rates, and FHA loan rates are exploding online because Americans are worried. They know something feels wrong. Homes are becoming harder to afford. Refinancing is no longer saving people money like before. And many families are starting to realize they may spend half their lives paying interest instead of building wealth. That's the scary part. Most people think they're buying a house. In reality, many are buying decades of debt. Let's break this down. Imagine two different periods in America. A few years ago, mortgage rates were extremely low. People were locking loans around 2% to 3%. Monthly payments felt manageable. Buyers rushed into the market because borrowing money was cheap. Then everything changed. Inflation exploded. The economy became unstable. The central bank increased interest rates aggressively to slow spending. Suddenly mortgage interest rates jumped massively. Now a person buying the exact same house may pay hundreds of thousands of dollars more over the life of the loan. Same house. Different interest rate. Completely different financial future. That's what many Americans still don't fully understand. A mortgage is not just about the price of the house. The interest rate determines how much of your life you hand over to the bank. For example, a $400,000 home with a low mortgage rate may feel affordable. But when rates rise sharply, that same house can become financially dangerous. Your monthly payment grows. Your stress grows. Your financial flexibility disappears. And suddenly your paycheck starts serving the mortgage instead of serving your future. This is why so many people in America feel trapped right now. Because housing costs don't stop at the mortgage payment. That's another massive mistake people make. Owning a home includes property taxes, home insurance, maintenance, repairs, HOA fees, utility bills, emergency fixes, renovation costs. And if mortgage refinance rates stay high, homeowners lose one of the biggest escape routes they once had: refinancing into cheaper payments. Years ago, refinancing was like a financial cheat code. People refinanced into lower rates and saved hundreds monthly. Today, many homeowners are stuck with expensive loans and fewer options. That's why mortgage news daily updates are becoming important for ordinary Americans. People are constantly checking rate movements, hoping things finally improve. But even if rates slightly fall, the deeper problem remains. America built a culture where people believe bigger houses equal bigger success. And that mindset is becoming financially destructive. Some families stretch themselves to the absolute limit just to look successful. They buy homes they can barely afford. They use most of their income on monthly payments. They sacrifice investing. They delay retirement savings. They live paycheck to paycheck inside beautiful houses. From outside, it looks rich. Inside, it feels stressful. That's the hidden side of the housing market nobody talks about enough. A house can either become a wealth-building asset or a financial prison. And the difference often comes down to the mortgage. Here's something even more dangerous. High mortgage rates don't only affect buyers. They affect the entire economy. When rates stay high, fewer people buy homes. Construction slows down. Consumer spending weakens. Families avoid having children. People postpone moving. Debt levels increase. Financial anxiety spreads. Housing becomes a pressure point across the entire country. Young Americans especially are struggling. Many millennials and Gen Z buyers feel like they arrived too late. Home prices skyrocketed. Mortgage rates surged. Rent remains expensive. And wages often haven't kept pace. So now millions face a painful choice. Keep renting forever. Or lock themselves into massive long-term debt. Neither option feels great. That's why conversations around FHA loan rates are also increasing. FHA loans are often used by first-time buyers because they allow smaller down payments. But even those loans become difficult when rates remain elevated. A smaller down payment may help you buy faster, but it can also mean larger monthly costs and more interest over time. And this is where people must become extremely careful. Because banks don't always measure what's emotionally healthy for you. They measure what they can legally lend you. There's a huge difference. Just because a bank approves someone for a massive mortgage doesn't mean that person should take it. That's a lesson many Americans learned the hard way. Especially after the 2008 housing crash. Back then, millions believed home prices would rise forever. People borrowed aggressively. Adjustable rate mortgages exploded. Debt piled up. Then the market collapsed. Families lost homes. Savings vanished. Financial lives were destroyed. Today's situation is different in many ways, but one thing remains true. Debt becomes dangerous when people underestimate risk. And mortgage debt is some of the biggest debt most Americans will ever carry. So what should smart people do now? First, stop viewing houses emotionally. A home is important, but it is also a financial decision. Second, understand the total cost, not just the monthly payment. Third, avoid stretching your finances to impress others. And fourth, remember this. Owning a smaller affordable house is often smarter than owning a giant stressful one. Because real wealth is not about looking rich. It's about freedom. Freedom to invest. Freedom to save. Freedom to survive emergencies. Freedom to sleep peacefully without financial panic. Right now, millions of Americans are discovering that high mortgage interest rates can silently drain decades of income. And the scariest part? Most people don't realize it until years later. A mortgage can either help build your future, or quietly steal it one payment at a time. Imagine standing in front of two houses. Same street, same school district, same vibe. But here's the kicker, choosing one over the other could mean retiring a millionaire earlier, or working an extra decade. That's right, your dream home might secretly be stealing your dream life. Today, I'm going to show you how trimming just 10%, 20%, or even 30% off your home budget could unlock financial freedom you never thought possible. Okay, let's get real for a second. Numbers don't lie, but they can be sneaky. Because when you're staring at that dream home, the monthly payment might look manageable. But what if I told you that trimming just a little off the top could literally change your financial destiny? Meet Sarah and Jake again. They've got lender approval for a $700,000 home. Sounds exciting, right? But here's the twist, they don't have to spend all of it. Let's line up their options. Option 1, $700,000 home. 3, $500/month. Option 2, $630,000 home, 10% less, $3, $100/month. Option 3, $560,000 home, 20% less, $2, $800/month. Option 4, $490,000 home, 30% less, $2, $400/month. Now, let's zoom in on the differences. 10% less equals $350 saved every month. 20% less equals $700 saved every month. 30% less equals $1,100 saved every month. At first glance, $350 might feel like, meh, that's just a few dinners out. But here's the kicker, mortgages last 30 years. That, meh, turns into a wow when you stretch it out. Let's play the long game. If Sarah and Jake invest the difference instead of spending it on a bigger mortgage, here's what happens over 30 years at an 8% return. $500 per month, $750,000. $1,000 per month, $1.5 million. $1,500 per month, $2.25 million. Pause for dramatic effect. That's not just pocket change. That's millionaire status money. That's freedom money. That's quit your job and travel the world money. Here's a fun way to look at it. $350 per month feels like coffee money. But stretched over decades, it's college tuition money. $1,000 per month? That's luxury yacht money. So when people say, it's just a few $100, they're missing the bigger picture. Small sacrifices today equals massive rewards tomorrow. And remember, the mortgage isn't the only villain here. Bigger homes mean higher property taxes, higher insurance premiums, more expensive utilities, more maintenance headaches. Rule of thumb? The true cost difference is often 25 to 50% higher than the mortgage gap. So that $350 per month savings could actually be closer to $500 once you factor in everything else. And that $1,000 per month? More like $1,500. Which means the compounding math gets even crazier. Here's the truth. Every dollar you don't lock into a bigger house is a dollar you can put to work for your future self. And trust me, your future self is going to thank you. Because while your friends are stressing about property taxes, you'll be sipping margaritas on a beach, funded by the money you saved decades ago. It reframes the decision from, can I afford this house, to, what am I giving up if I buy it?